Today, sounding the retreat. Hello again, it's Martin North from Digital Finance Analytics, one latest posts covering finance and problem news with a distinctively Australian flavour. Well, there was a spate of interesting articles that hit the presses today, and each in their own way helped to underscore the current property and finance dynamics in Australia, and there are a few retreats sounding. So firstly, this from Clancy Yates in the SMH. Two of Australia's major banks are cutting back on new lending to more highly indebted borrowers as financial institutions and regulators prepare for the impact of rising interest rates on mortgage customers. As money markets bet on a series of interest rate rises this year, ANZ Bank this week said it was no longer accepting loan applications from borrowers with total debts more than 7.5 times their income. Previously, the bank was prepared to consider applications from customers with debt-to-income (DTI) ratios of up to 9 times. Regulators have said banks should make sure borrowers have adequate buffers as interest rates rise. It follows a similar move from National Australia Bank, which this month cut its debt-to-income ratio limit from 9 times to 8 times. While both banks' upper limits are still high, the moves are a sign of lenders seeking to cut their exposure to higher risk lending as interest rates rise, ending a period of ultra-cheap debt and booming house prices. The Council of Financial Regulators has also been urging banks to maintain sound lending standards in recent months, following growth in higher risk lending in the second half of 2021. An ANZ spokesman said that the lender regularly reviewed its lending appetite and policies in response to changes in the economic backdrop. Given the changing interest rate environment, we recently notified brokers and bankers that from June the 6th, we will only accept home loan applications where the debt-to-income ratio is less than 7.5, the spokesman said. Announcing the move to mortgage brokers, ANZ people who borrowed a high multiple of their incomes were more vulnerable to adverse changes in circumstances or loan conditions. ANZ made it clear there was no wriggle room in its policy. There is no appetite to consider applications with a DTI of 7.5 or above, the note to brokers said. NAB executive Kirsten Piper pointed to the bank's responsible lending obligations and said it welcomed ongoing consultation with regulators. We are committed to lending responsibly and want to ensure customers are able to appropriately manage their repayments both today and in the future. To do this, we work with all customers to understand their individual circumstances and assess applications based on a range of measures. The Australia Prudential Regulation Authority regards DTI ratios of 6 times and over as high, and in October last year said it asked banks to review their risk appetite for this type of lending. Commonwealth Bank says it uses higher lending parameters for loans with a DTI ratio of above 6 times when the customer also has a small deposit. Westpac requires a manual credit assessment of customers with a DTI ratio of above 7 times. And CBA and Westpac, the two largest mortgage lenders, both have a maximum DTI ratio of 9 times. Money markets are betting the Reserve Bank will raise the cash rate again in under 2 weeks, with a 0.4 percentage point increase seen as the most likely increase for June. And by the end of the year, markets are pricing in a cash rate of 2.6%, compared with 0.35% currently. But many economists predict smaller increases in rates than this. Steve Mickenbecker, Group Executive for Financial Services at CanStar, said he was not surprised by the changes from ANZ and NAB given the looming rate rises, which could pressure borrowers who have stretched themselves. Mickenbecker said DTI ratios were generally used as a rule of thumb, and banks also use other buffers to check how customers would cope with higher rates. There's a lot of uncertainty out there. Yes, the banks build in the buffer, but as rates go up, the buffer gets skinnier, Mickenbecker said. And now, so far as the property market is concerned, the AFR said that rising interest rates, more cautious households and overseas holidays after 2 years at home point to lower listings and less stock on the market as the property sector takes a breather. The combined capital city preliminary clearance rate rose less than a percentage point to 63.7% over the week to Saturday, even as volumes doubled, and agents said they were already fielding fewer queries about future listings. When the market's building, it builds from the bottom up. When it comes off at the top end and comes down, said veteran Melbourne agent Greg Hocking. We're getting good turnover on properties up to $2 million in our area and up to $2.5 million, but when you look above 3, 4 or 5 million, we're not seeing a lot of properties coming on the market. There are a lot of vendors saying we're going to sit this out for the time being. Mr. Hocking, who focuses on inner southern Melbourne's premium Albert Park, said the drop-off in inquiries from potential sellers for campaigns starting in July and August wasn't a reflection of rising rates. It's sentiment that moves quickest, he said. The sentiment's moving quickly. The pickup in the combined capital city clearance rate from a preliminary 62.9% a week earlier, later revised down to 61.3%, was the first increase after 5 weeks of decline. The number of scheduled auctions rose to 3,229, almost double the previous week's 1,672. And in Sydney, where a 4-bedroom house in East Ryde sold at auction on Saturday for $1.9 million, 3.6% over the $1.84 million reserve price, Bell Property Hunters Hill agent JSA said conversations about future listings were not dropping off, but vendors were becoming more realistic. The aspirational vendors are definitely dropping off, Mr. Asay said. They're the ones who'll only sell if they get $3.5 million when the house is worth $2.2 to $2.3 million. They've retreated. But the sales campaign for the 5 Bromwell Avenue house reflected the changed nature of the market. We guided sellers to $1.8 million and then adjusted to the $1.5 million because there was lukewarm interest, Mr. Asay said. We couldn't comfortably sit down with the owner to say that come auction day we were going to be selling. Lowering the guide a week and a half before the auction did bring buyers out. 7 biggers registered, 3 of them bid, and a young family from Ryde bought the property. People are becoming a lot more value-driven, Mr. Asay said. If they don't have a perceived sense of value, they're not wanting to be part of a campaign. In Sydney, where the number of scheduled auctions more than doubled to 1,112, the first 1,000 plus auction week in 7 weeks, the preliminary clearance rate picked up to 62.8% from the previous week's preliminary clearance of 61.7%, which was later revised down to 58.4%. And in Melbourne, the clearance rate from the reported 1,220 results of 1,460 auctions also rose to 62.9% from 61.9% a week earlier. That's a figure subsequently revised up to 62.2%. A lot of people have pulled their properties off the market, Melbourne buyer's agent David Morrell said, yet those that kept going got good results. In Bayside Hampton, a 5-bedroom family home at 18 Bolton Avenue that was advertised with a selling guide of $4.5 to $4.8 million sold for $5.85 million after an auction that pitched 4 bidders against each other. Marshall White agent Kane Lanon declined to discuss the sale, and in Perth there were just 20 scheduled auctions, too few to provide a meaningful clearance rate. Ray White's sales agent Deb Brady said listings in the city's leafy western suburbs such as Cottesloe were likely to fall in the coming months as owners prepare to travel overseas for the first time in 2 years. There's a huge cohort of that top-end seller. They are going overseas for at least a month, maybe 2 months. A lot going for 3 months, Ms. Brady said on Sunday. It's going to be a slower winter. They'll come back and then maybe we'll be on for a strong spring season. And finally, this. The central bank should not compound the failure to control inflation with a second error by weakening growth too much. This would risk a prolonged and painful balance sheet recession, wrote Alex Joyner, chief economist at IFM Investors, in an opinion piece in the AFR. There is a real economic challenge coming for the newly minted federal government. Buoyed by policymakers' success in staving off the worst of the pandemic-induced recession, some dared to think that the post-pandemic environment will be somehow different, somehow better. What's becoming abundantly clear is that it won't, at least not in the near term. Advanced economies have emerged from the pandemic no better than they were in the years leading up to it. they still face deep structural issues that are constraining potential economic growth rates, most notably a dearth of productivity growth and a business sector reluctant to invest. Unprecedented fiscal stimulus and monetary accommodation is no panacea for these deficiencies. As this realization has dawned, market economists have rushed to downgrade their 2022 and 2023 economic growth forecasts for the UK, the US, Eurozone, Japan and China, but not for Australia. Well, not yet. Like most economists, we always expect that developed economies, including Australia, would experience a growth slowdown after a post-pandemic spike. However, this is happening faster than expected due to persistently elevated risks of pandemic-induced inflation that have been exacerbated by the impact of the Eastern European conflict on energy and food prices. The conflict is also bringing direct downside risks to global growth. This is occurring just as central banks are rushing in to fix their collective miscalculation about whether this inflation would be persistent. This quest for redemption comes with a cost, namely less economic growth. Aggressive tightening will clearly risk a recession. While there is some merit in the actions of central banks, engineering a soft landing for economies will be a difficult task. Any overconfidence in their ability to simultaneously bring inflation to heel risks compounding their first error with a second by weakening growth too much. This would cause a recession or worse, stagflation. Australia may be no different. We have for some time expected the domestic economy to eventually recover to its 2019 state. This is becoming an uncontroversial view. The Reserve Bank of Australia expects growth to deaccelerate to just 2% by mid-2024. This is based on population growth forecasts similar to those presented in the federal budget. The problem is that the 2023-24 population growth forecast is 1.3%, implying the RBA's GDP per capita growth expectation is a lackluster 0.7%. So the RBA believes the economy is going back to 2019 at a time when Australia is facing the same structural challenges as other advanced economies. Our historical good fortune was that we patched over these challenges with population growth and bouts of unexpected resource price strength. We seem to be hoping in coming years to again be the lucky country. But in an important way, Australia is structurally different because we will exit the pandemic with more public and private debt than ever before. Of particular concern is Australia's household debt, which is elevated well beyond the vast majority of peer economies. We have paid a higher price than most for failing to recognise that monetary policy is a cyclical tool and should only complement ongoing productivity-enhancing fiscal policy as a driver of growth and living standards. We've over-relied on monetary policy and let the momentum of reforms wither. And now a reckoning has come. Like other central banks, the RBA will seek to raise interest rates to tame inflation, but it is flying blind in terms of the impact its actions will have in the current economic environment, given its last experience with a tightening cycle was a decade ago. This suggests that a gradualist approach is required with less aggressive tightening than many economists and financial markets now expect. If current market pricing were to come to pass, the cash rate would quickly exceed 2019 levels, but the economy is in no better shape than it was back then. Such aggressive tightening would clearly risk a recession. And there's also the risk that aggressive tightening produces not just an economic downturn, but a more painful and prolonged balance sheet recession. This is because there is more debt in the Australian economy now than ever before, and extreme interest rate settings have been capitalised into housing prices. A material fall in housing prices in response to higher interest rates could result in heavily indebted households falling into negative equity. For many households, particularly those at the margin, this could dramatically shift spending behaviour as a greater share of income is devoted to debt reduction. Economic growth will be materially slower in this environment. And this is exactly the reason why the RBA won't fulfil market pricing and is likely to disappoint the more hawkish of economists' forecasts by acting to contain inflation more prudently. Put it simply, this is a recession we don't have to have, he says. So if you stand back and just think about what we've covered here, Banks tightening their lending standards, although they're still very loose in absolute terms. Property momentum perhaps easing and some deciding not to sell. And the prospect of higher rates, although whether the higher rates will be calibrated as per the market or more gently is a genuinely open question. And as John Adams and I discussed recently, of course, the real issue is this: they can't afford to lift rates too high, because if they lift rates too high, they will crash the housing market, and that will in turn lead to financial instability. So probably rates will go up and then come back down. And if you want more detailed conversations today about what's happening in the property market, why don't you join Edwin, Almeida and myself at 6 p.m. Sydney time tonight for a live rant where we're going to discuss the latest dynamics. Should be fun. Do come and join us. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high. Price discovery and price transparency are hard to find. And then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.